almost inevitable. On May 2nd, Gary Shilling said that a recession in the United States would occur before the end of this year. Furthermore, Shilling doesn't use that expression lightly. He became Merrill Lynch's first head economist in 1968 at the age of 29. He predicted the recession of 1969. He was sacked by the CEO for it. Nevertheless, the recession arrived precisely when he predicted it would. He recently told Business Insider 3 things that every homeowner should know. The housing market is frozen and won't thaw for years. The American consumer is on very thin ice, and stocks are headed for a 20 to 30% correction. He is now 88 years old and has been operating his own forecasting company for almost 50 years. Stocks are plummeting. The housing is chilly. A recession is nearly inevitable. Which of those 3 forecasts is already supported by this week's statistics? And which one is similar to 1969 and makes this arrangement more risky for homeowners than anything since the Great Recession? Before touching a single data point, understand who is making this call. Shilling set up Merrill Lynch's entire economics department at 29. He was named top Wall Street economist by institutional investors in 1975 and 1976. The Wall Street Journal ranked him the most accurate forecaster among 57 economists in 1997. He partnered with John Paulson on the subprime housing short before the 2008 crash and earned a 16-fold return. And in January 2006, 18 months before it happened, his newsletter ran an article titled, "The Housing Bubble Will Probably Burst." He didn't just say recession this time. He named 3 failures stacking on top of each other simultaneously: a frozen housing market, collapsing capital expenditures outside the AI sector, and a consumer running out of room. Every single one is verifiable from primary data released in the last 30 days. The NAR released April 2026 existing home sales on May 11th. The annualized pace came in at 4.02 million homes, roughly where we were in the depths of 2010, and the slowest housing turnover this country has seen in over 3 decades, despite the U.S. having roughly 6 million more jobs today than in 2019. Inventory sits at 4.4 months of supply. Median days on market climbed to 52 days in April. The 30-year fixed mortgage stood at 6.46% as of the week ending May 8th, the highest in 5 weeks. The mechanism behind the freeze is what makes this dangerous for sellers. According to FHFA data, 78% of all outstanding mortgages are locked in below 6%. Half, 50.6%, are below 4%. If you bought or refinanced between 2020 and 2022, the math of selling and rebuying at 6.46% simply doesn't work. And the buyers who are out there have lost their patience. The MBA released Q1 2026 delinquency data on May 14th, showing total mortgage delinquencies rose 40 basis points year over year. Adam, also reporting May 14th, showed foreclosure filings up 18% year over year in April, with completed bank repossessions up 42%. ICE Mortgage Technologies may monitor flagged 878,000 loans, either severely delinquent or in active foreclosure, the largest such volume since June 2018 outside the pandemic peak. Prediction 1 confirmed. In 1969, inflation had crept from 1.2% in 1964 to 5.4%. The Federal Reserve tightened the federal funds rate from around 4% to a peak near 9.19%. The 10-year Treasury climbed from roughly 5% to nearly 8%. Stock valuations were stretched after a decade-long bull run, and the housing market had been hammered by a credit crunch. Housing starts dropped roughly 25%. The S&P 500 peaked in November 1968 and fell 33% by May 1970. Now look at 2026. Headline CPI as of April is 3.8%. PCE inflation is 3.5%. Well above the Fed's 2% target. The Fed held rates at 3.5 to 3.75% at its April 29th meeting with 4 dissents, the most at a single FOMC meeting since 1992. The Shiller cyclically adjusted price-to-earnings ratio sits between 39.6 and 41.7, the second highest level in U.S. history, exceeded only by the dot-com peak. The Buffett indicator, market cap to GDP, is at 219%. And the housing market is the most frozen it's been in decades. But here's the part of the parallel that makes 2026 more dangerous than 1969. When the 1969 recession hit, the Fed had room to pivot. By April 1970, they were already easing. That easing accelerated the housing rebound. In 2026, with PCE inflation at 3.5%, the Fed cannot cut aggressively without reigniting inflation. The mortgage rate cushion that bailed out homeowners in 1970, 2001, and 2020 is not coming this time. That's what makes this setup structurally more dangerous for homeowners, and it's a part no other channel is connecting. Shilling told Business Insider that broader capital expenditures grew just 3.9% at the end of 2025, down from a pandemic peak of over 24%. Strip out the AI sector, and that number goes negative. Pantheon Macroeconomics confirmed in December 2025 that non-AI private fixed investment is an outright decline. Meanwhile, Bank of America projects capital expenditures from just 5 hyperscaler companies, Amazon, Alphabet, Microsoft, Meta, and Oracle, will exceed $800 billion in 2026. Goldman Sachs notes this hyperscaler spending now consumes roughly 75% of those companies' cash flows, and uses a phrase similar to tech company expenditures in the late 1990s. That's the dot-com analogy from Goldman Sachs on the record. 3 numbers, none more than 2 weeks old. The personal saving rate as of March 2026 sits at 3.6%, against a 20-year average of 5.9%. The University of Michigan Consumer Sentiment Preliminary for May 2026 came in at 48.2%, an all-time record low in a series going back to 1952, lower than 2008, lower than COVID, lower than the 1980 recession. And the New York Federal Reserve's household debt report released May 12 shows credit card balances 90-plus days delinquent have climbed to roughly 12.3%, only about 1 percentage point below the Great Financial Crisis peak. Auto loan 90-plus delinquencies are at 5.2%, within 0.06 percentage points of the all-time high set in Q4 2010, except in 2010, unemployment was above 9%. Today, it's 4.3%. The American consumer is breaking down at full employment. Cotality, formerly CoreLogic, released their Q4 2025 homeowner equity report and confirmed something that has not happened in this entire housing cycle. Aggregate U.S. homeowner equity declined by $78.8 billion year over year, roughly $8,500 per borrower. For the first time in this cycle, American homeowner equity is shrinking. Florida homeowners lost an average of $29,400 per borrower. California, $24,700. Arizona, $23,900. Cotality stress test showed that if U.S. home prices fell just 5% from here, an additional 372,000 homes would flip into negative equity overnight. The biggest risk to homeowners in 2026 isn't a direct housing crash. It's a stock market correction triggering a household consumption shock. Federal Reserve research puts the consumption response at roughly 3.5 cents per dollar of wealth lost. With 58% of American households now owning stock, the highest share on record, higher than the dot-com peak. A 25% S&P decline would erase roughly $12 trillion in household wealth. The resulting consumption pullback would hit retail, services, and ultimately the labor market. Homeowners who suddenly need liquidity would be forced into a frozen housing market with no buyers, and a Federal Reserve unable to rescue them with rate cuts. Most housing analysts think housing breaks first and drags everything down. This time, it may be the other way around. If you own your home with substantial equity, your cushion is real, but your paper wealth is not your liquid wealth. Cotality data shows tappable equity has flattened for the first time in 2 years. Home equity lines of credit have climbed for 13 consecutive quarters. The people least able to absorb a downturn are those who tapped equity in the last 18 months. If you're a seller, there are roughly 630,000 more sellers than buyers in the U.S. housing market right now, the strongest buyers market in Redfin's tracked history. Miami has 148% more sellers than buyers. Austin, 112% more. Realistic pricing wins. Lenders' Q1 earnings call confirmed builder gross margins fell from 18.7% to 15.2% because they're carrying 14% in sales incentives, 3 times normal. If billion-dollar builders are discounting that aggressively to move inventory, individual sellers need to price accordingly. If you're a buyer, you may be looking at the best negotiating leverage in 15 years. D.R. Horton confirmed on their April 21st earnings call that 73% of their closings use mortgage rate buydowns. The big builders are doing the heavy lifting. Use it. The math is plain. A $400,000 home at a 3.5% mortgage costs about $1,800 a month in principal and interest. At 6.46%, That same home costs $2,520, $720 more a month, nearly $9,000 a year in additional interest go to the lender instead of building equity. That's why sellers are stuck, buyers are squeezed, and this market is frozen. Shilling has been wrong before. Bears get loud at the top of every cycle. The April jobs report came in at 115,000, better than expected. Q1 corporate earnings rose roughly 28% year over year. Goldman Sachs puts U.S. recession odds at 25%, JP Morgan at 35%, and Morgan Stanley doesn't have a recession in their base case at all. The bulls have real ammunition. But Shilling's argument isn't that everything looks bad. His argument is that the specific combination, saving rate at 3.6%, Shiller PE at 39%, frozen housing turnover, non-AI capex in decline, consumer sentiment an all-time low, and credit card delinquencies near great financial crisis levels, has only appeared together in one comparable moment in modern U.S. history. That moment was 1969. The man who called 1969 is calling this one. He may be wrong, but the cost of ignoring him, if he's right, is measured in tens of thousands of dollars per household. For the American homeowner in 2026, equity is quietly evaporating one quarter at a time while the surface still looks calm.